When a mortgage lender analyzes your credit for a mortgage application, we typically look at several key factors to assess your credit worthiness and determine the terms of your loan. Okay, so now let's get into it. Let's go over some of the main things we consider. The first is credit score. Your credit score, usually derived from your credit report, is a numerical representation of your credit worthiness. Lenders often use FICO scores or Vantage scores, which range from 300 to 850. A higher score indicates lower risk to the lender. Number two, payment history. Lenders assess whether you've made payments on time for credit cards, loans, and other debts. Late payments, defaults, bankruptcies, foreclosures, or other negative marks on your credit report can lower your score and indicate higher risk. So let's be honest. If you were late on a credit card payment for $25 or $50 a month, do you think the lender is going to feel confident that you will make the $1,000 or $2,000 a month mortgage payment? Number three, debt to income ratio or DTI. This ratio compares your monthly debt payments to your gross monthly income. Lenders use this to evaluate your ability to manage payments alongside your existing financial obligations. A lower debt to income ratio is generally favorable. Number four, credit utilization. This measures the amount of credit you're using compared to your total available credit limits. Higher credit utilization ratios or maxed out credit cards can suggest that you might be overextended financially. Number five, length of credit history. Lenders may consider how long you've had credit accounts open. A longer credit history can be seen as more stable, but it's not necessarily a decisive factor. Number six, new credit. Opening several new credit accounts in a short period may indicate financial stress or an increased risk of default. Number seven, types of credit. Lenders may look at the mix of credit accounts you have, such as credit cards, installment loans, and mortgages. Having diverse credit history can be seen as positive, but it's not as significant as other factors. And finally, number eight, credit inquiries. Each time you apply for new credit, it generates a hard inquiry on your credit report, which can temporarily lower your score. We see this a lot when someone has been shopping for a new car. Multiple inquiries within a short time frame might suggest you're in financial trouble or seeking to take on more debt. These factors collectively help lenders evaluate your credit worthiness and assess the level of risk involved in lending to you. The specifics of how each lender weighs these factors may vary, but they all play a crucial role in determining whether you qualify for a mortgage and what interest rate you're offered. If you have questions about credit or mortgage financing in general, please reach out to me. I am here to help you with all your financial and mortgage needs.